Hello everyone and welcome back to the Saigal Sea Trade podcast. I'm Research Analyst Trisha Mohite and I'll be your host for today's episode. So today we are diving into the heart of the tanker market with someone who needs no introduction. We have Mr. Sandesh Ghandat with us, who is our very own shipping expert. So welcome to the episode, Sandesh.
Thank you, Trisha, for inviting me once again. It's a pleasure to be here, and I'm kind of keen to share my thoughts on one of the interesting topic today.
Alright, Sandesh, so let's start and kick things off big. So, what's really going on in the VLCC world? And could you tell us why does it feel like we're constantly swinging between bullish bursts and the bearish drags?
Absolutely, Trisha, and I love how you put that swinging between bullish burst and bearish tracks. You know what? It really captures the volatility we have seen lately. So let me start with the Middle East Gulf first. It's a kind of a bread and butter for VLCCs. So after we saw what I would call a brief surge of optimism. A decent number of second decade April cargoes hit the market and owners quite frankly smelled the opportunity. So they kind of tried to hold back ships to engineer a mini rate rally. But here is the catch. The charters, they weren't biting. In fact, many of them had many as 10 offers per cargo. And that tells us one thing loud and clear. The market, you know what? It's oversupplied. And that's it. Like Middle East Gulf, let's come back to Atlantic. We saw some ex-West Africa and ex-US Gulf trades propping up early week sentiment, specifically ex-USG to China. The 8.5 million mark, it was kind of holding strong. But sentiments, as always, it's kind of a fragile thing. And as soon as charterers sensed more ships coming to, open post May 5, and that is second week of May, the music, it's literally stopped because freight dipped to 8.65 million and we saw that signature VLCC pattern momentum in reverse. This market is very emotional right now. It reacts faster than it reasons, and the moments of hope outpaces fundamentals, and bam, reality sets in. Now going forward, unless see a serious rebound in ex-US Gulf volumes or some kind of a geopolitical triggers that may delay some cargoes and shrinks the position list, we are likely in the more softening in the coming weeks. And in fact, I would argue we are staring down a slow bleed for the rest of the April if cargo count doesn't rise.
You're absolutely right, Sandesh. Now, I have to point out when you said emotional swings, and that reminds me to talk about Suezmaxes. So, I hear there was a lot of noise about the CPC terminal disruptions. So, could you tell us how did that play out, and what does it really tell us about the fragility in the market?
Well, this is where it gets really interesting. The Suezmax segment is like the nervous system, and it is nervous system for mid-size crude world, and it reacts fast and feels pain sharply. So last week, it started out looking fairly balanced, particularly out of West Africa, and then you had a healthy demand, scent of market fixing, and owners they are kind of feeling fairly secure. But then the CPC terminal story broke. 2 of 3 SPMs offline, and now if you are not familiar, those SPMs are a huge conduit for Kazakh crude flowing to the global market, and suddenly 1/3 of that outlet was cut off. So if that is happening, the outcome, that ripple was immediate, not because charterers panicked, but because tonnage that would have cleared out and the region kind of hung around. Now eastbound demand out of WAF, it also dried up, and you had a ships ballasting from the east, and it's another red flag. So this created a stealth of oversupply situation. Owners who were bullish on Monday were undercutting each other by Thursday. And that's the classic case of sentiments flipping on the dime. So what this tells us, Trisha, is, Suezmax, they are kind of walking a tightrope right now. And if demand in Brazil and the US Gulf, it doesn't revive, or, if we get more ballasters from the east showing up in the Med or WAF, rates will keep falling. So my analysis is there is no cushion here, no margin for error.
Thank you so much, Sandesh, for that brief analysis on both the VLCCs and the Suezmax markets. Now, let's zoom into the CPP market, and I have to say it's been a wild ride. Talking about the LR1s, the LR2s, and the MRs, could you tell us what's driving the softness across the board?
Trisha, you have opened the floodgates this one. CPP is a spaghetti ball of dynamics right now, specifically in the AG Japan route. So let's take LR1's example first. On TC5, we have seen the rates fail to world scale 145.94 last week, and even earnings are dropped by nearly 9%. But why is that? Because April is a traditionally heavy month for the cargoes, but this particular year cargo volumes just didn't show up. Charterers sat on the sidelines, and with every day of inactivity, the tonnage list grew longer and more desperate. So initially we thought that it's a first week of April, things might started slow when the month is starting, but as we move ahead with the week, we have seen the similar thing, and that's why we are seeing that tonnage list grew longer and it is kind of more desperate to clear out the tonnage. Now talking about LR2s, so they didn't fare much better. We have seen TC1 rates, they slipped by world scale 5 to world scale 150, with TC is also sliding to 34,000, just above $34,000 per day. That may not sound disastrous, but remember, these are high spec, high op cost ships. So every point matters. So you need a tight list or a surprise demand spike to keep that rates float. And then there is the MR segment. This is where we have seen a real pain. So we have TC12 Sikka to Japan. It dropped by nearly 10 points, and even East Africa's TC17, another 39 point drop. So we have seen TCs on TC70 got cut in the half, almost $6,000 per day decline. So think of an think from the perspective of MR owner, where who was getting around $24,000 per day in March. Suddenly they are getting around $12,000 in April, and that is directly 50% reduction. So with no clarity on how long the slump will last, they have to make some serious decisions. But that's not just the business problem, that's a livelihood question for them. And the pressure is also psychological, because charterers, they kind of lowballing aggressively, betting on the further declines. So there is even talk that we have hit the bottom, but I think that's kind of a premature. If we don't see at least 20 to 25 knee April quotes in the next few days, this could even get uglier. Now that's about the spot market, but let me also focus, or let me also put out some shadow on TC market. We have seen 7 MRs fixed last week, and on a weekly basis that number is kind of a high, but still we will not see any significant momentum in the coming days, because the cargo and charters, they are kind of a sidelined, because there is universal economic slowdown.
Thank you so much, Sandesh, for that brief update on the spot and the TC market for the CPP segment. Now, let's also talk about the LPG market. Could you tell us any moment from past week that really captured the market's unpredictability?
Yes, absolutely. I want to tell you about a moment in the LPG market that really stuck me. So in the midweek, we were tracking that Ras-Tanura Chiba route. It usually hovers in the high $50 per metric ton. And then suddenly we have seen Australia fixture printing at a crazy premium to the index, like eyebrow raising levels. And here is the kicker. It wasn't just one off. 4 more deals followed, and all dated for the second half of the April. In an oversupplied tariff sensitive environment, that's a kind of a flare going up in the sky, and even we may see further fixtures will follow in the coming weeks. They were clearly trying to build a narrative. Rates are back and the markets is alive. But then we come to the Friday, and the US China tariff announcement, it kind of a slam into the market like a rogue wave. Suddenly charter about the US Far East arbitrage, that window, it's supposed to be getting higher, but it's now narrowing. And then we have seen the rates, they kind of a dip to $105 to $110 per metric ton on Houston Chiba route. Then there are reciprocal impact in the market, because then the prepper traders, they kind of pull backs, and the overall LPG sentiments, it's collapsed. So having said that, this is what I love and hate about this market. You can really have a rally in the making on Tuesday, and then the full blown retreat by Friday. So this LPG market is kind of a very volatile right now, and it is from the all perspective.
right, Sandesh, thank you so much for such an insightful discussion that we had today with you. It has been nothing short of a masterclass, I think. We've only scratched the surface, and I can't wait to continue more of this. So, thank you for coming to this episode.
Thanks, Trisha. Thanks for inviting me once again. It's always a pleasure to be here and to share my thoughts with you and with our audience. Thank you.
And to all our listeners, thank you so much for tuning in. Do not forget to share and subscribe. And for more details and for more such episodes, navigate safely and stay tuned.